For almost 4 decades, Adobe has been the creative industry's backbone, the quiet engine behind design, photography, film, marketing, and content creation. But suddenly, everything changed. AI didn't just bring new tools, it rewired how creativity works. And rather than defending the old way, Adobe is leaning into the biggest transformation in its history. This next decade could redefine Adobe's entire identity. Not because its dominance is fading, but because AI might make the company more powerful than ever. Welcome to Facts Not Forecast, your daily edge in the stock market. Facts, insights, and opportunities you won't hear anywhere else. It perfectly captures the scale of what's happening at Adobe. You've got this company founded way back in 1982, and they basically wrote the book on how we make digital content. And now, generative AI comes along, and they have to completely rethink, well, everything.
That's really the core of this deep dive. To get the transformation, you first have to understand what they built. Adobe, have three main segments. You've got digital media, digital experience, and then this smaller legacy business, publishing and advertising. But the real engine, the heart of the brand, that's digital media.
That's the Creative Cloud and Document Cloud?
Exactly. The tools for designers, for marketers, for, just about any creative professional.
And they were geniuses for shifting to subscriptions years ago. It gave them this super predictable revenue stream. But now with AI, the CEO himself called it the biggest opportunity in decades. It's not enough to just add an AI button to Photoshop.
No, it has to be a total overhaul. And that's what they're doing. They're positioning the entire company as an AI-powered creative and document platform. And that's not just, some marketing slogan. It's a massive strategic shift inside the company.
All aimed at boosting engagement and keeping that recurring revenue growing.
Right.
So let's talk about the products. What's the proof that this is actually working? I guess we have to start with Firefly.
You have to. On the creative side, you have Firefly and also something called Gen Studio. These are their big generative AI tools, and the source material calls them the engine for creative evolution.
So instead of a designer spending hours tweaking pixels, they can just use a simple prompt. They can generate whole assets, resize an entire campaign for different platforms, or, just instantly remove an object from a photo. It fundamentally changes the speed of work.
It changes the speed, yeah, but also what the user can do. Now, you mentioned Document Cloud. That's the Acrobat side of things. It sometimes gets overshadowed by Photoshop. How is AI playing out there?
That's where they're chasing massive volume and productivity. They've introduced the Acrobat AI assistant.
Okay.
It can instantly summarize, say, a 100-page PDF. You can ask it questions about the document in plain English. It'll even draft emails based on what's in the file.
So it turns Acrobat from just a static PDF reader into, an active assistant.
It becomes an active knowledge tool. And that's targeting millions of office workers, not just the niche creative pros. That's a really powerful 1-2 punch. But here's the big question for any investor. Is all this AI stuff just defensive? Is it just a way to stop people from leaving for competitors? Or is it actually driving new revenue?
And the data confirms it's a driver. It really does. It directly pushes back on that investor skepticism.
Okay, so what are the numbers?
In Q3 of fiscal year 2025, Adobe reported that its AI-influenced annual recurring revenue, the ARR, it surpassed $5 billion.
Hold on, let's just stop there for a second. $5 billion. That's not a forecast, right? That's actual realized recurring revenue.
That's realized ARR, yes.
So that means tools like Firefly and the AI assistant are directly tied to $5 billion worth of customer subscriptions.
That's exactly what it means. And crossing that number, it proves that they've already figured out how to integrate AI into their monetization engine. It calms those early fears that AI would just be a huge cost center or that they'd have to give it all away for free.
And the core business is still growing on top of that.
It is. The main digital media segment revenue, it rose 11% year over year in Q3 to $4.46 billion. So you have steady growth, with AI acting as this really significant new tailwind.
Okay, but this is where the story gets tense. For decades, Adobe's moat was just, you couldn't get past it. You learned Photoshop in college. Your company used it. You were locked in for life.
It was a massive time investment.
Exactly. But our sources are saying that the competitive landscape has, and I'm quoting here, fundamentally changed.
It really has. It's not just about fending off some small niche tool anymore. They're now fighting tech giants and these super nimble AI-native startups.
And the sources specifically mention who?
They call out pressure from AI-native rivals like Google's Gemini tools.
And I remember the market reaction back in early 2023. There was that narrative that just took over. OpenAI's breakthrough is terrible for Adobe. A lot of skepticism.
Oh yeah, that sentiment captured the core fear perfectly. The fear is that AI democratizes creativity too much. Well, the old Adobe workflow was all about editing pixels. It was meticulous, it took forever, and that's what justified the high subscription costs. The new workflow is about generating concepts from text.
Right. If some other AI tool can create a professional-looking image instantly, why do I need my expensive Adobe subscription?
That's the threat. It's not just another tool. The threat is that the core skill Adobe sells, that expert pixel manipulation, is being, well, de-skilled by AI.
So how do you sell Firefly to a professional who's worried it's going to take their job?
That is the tightrope they have to walk. Adobe's counter-argument is that Firefly isn't just an image generator. They sell it as a content supply chain tool.
Supply chain, what does that mean?
It means it's seamlessly integrated across their entire suite Premiere for video, After Effects, Illustrator. And crucially, it's trained on commercially safe data for licensing. A standalone generator like Midjourney gives you a great image, but getting that image into a professional video workflow or make sure it's legally compliant, that's where Adobe keeps its lock-in.
So it's workflow versus just image generation. And that's really the heart of this whole hold versus buy debate we're seeing among analysts, isn't it?
It is. The bearish view, the hold rating, it's all built on that risk of the moat eroding. The bears argue that Adobe has been knocked from its pedestal.
Because the competition is just too intense now.
Exactly. The barrier to entry is lower, and that leads to slower growth forecasts. So the question becomes, why should Adobe trade at a premium valuation if its dominance isn't absolute anymore?
They made the switch to subscriptions, which was brilliant, but maybe they aren't adapting to this next phase fast enough to justify that high growth stock price.
That's the bear case in a nutshell. But the bullish view, it argues Adobe is still a wide moat champion that's just trading at a discount right now.
Okay, and what's their argument?
They point to the incredibly sticky subscription base, the proven monetization, that $5 billion ARR figure, and this big strategic AI push as evidence that they're securing their dominance for the long haul. They believe the ecosystem lock-in, especially for big companies where compliance is everything, is just too strong for new rivals to break through quickly.
It's a great summary of the tension in the market. Okay, let's pivot from the narrative to the numbers, because no matter how loud the competitive noise gets, the quality of the actual business has to matter.
And when you look at the financials, I mean, we are talking about one of the highest quality, highest margin software businesses on the planet. Just look at the profitability. Their gross profit margin is 89.1%.
Almost 90%. That's not just good, that's basically a pure intellectual property business. The cost of goods is almost zero.
It's incredible software efficiency. And they turn that revenue into profit so well, their net profit margin is a solid 30%.
Wow.
And if you want to look at how efficient management is, their return on equity, the ROE, is an outstanding 59.1%.
So for every dollar they reinvest in the business, they're generating almost 60 cents back immediately.
Right. That level of quality is why even the most bearish analysts have to admit the core business is a fortress.
They're just cash flow machines. And I know they recently beat earnings estimates, too.
They did. In Q3 2025, EPS was $5.31, which beat the $5.18 estimate. It was a small beat, but still positive. And historically, they've been this reliable engine, annual revenue growing consistently around 11%. Fiscal year 24 revenue was $21.5 billion.
Okay, so that's the track record, rock solid. But here's the critical part. If the business is so good, why has the stock been so volatile? And I think the answer is in the forward-looking growth.
This is the absolute core of the conflict. Analysts are projecting slower growth rates over the next few years. It signals that all this competitive pressure and maybe some market saturation are starting to bite.
And what are those projections?
Revenue growth is projected at about 7.8% per year, and earnings growth is forecasted 7.1% per year.
And there it is. That's the key. You have a company that's valued like a high-growth tech stock.
Right.
But it's now projecting future growth that's actually slower than the forecast for the broader U.S. market, and even slower than the software industry average. You're being asked to pay a premium price for what's starting to look like utility-level growth.
That mismatch is exactly what's driving the volatility in the stock price. But even with that slower growth, the company is still incredibly shareholder-friendly with how it allocates its capital.
Meaning no dividend, right?
Correct. They don't pay a dividend. The yield is zero. Instead, they pour that cash into massive share buybacks. Their buyback yield is really high right now at 8.4%. They clearly see their own stock as the best investment out there.
While that level of confidence from management is great to see, especially when the market is nervous, isn't it also sort of an admission that they don't see any big, high-growth companies to acquire right now?
That's a fair point. It's a classic debate. Well, they clearly believe that buying back their own stock offers a better, more immediate return for shareholders. And they put their money where their mouth is.
With that big new repurchase program.
A huge one. A new $25 billion share repurchase program announced in the first quarter of 2024. That kind of consistent buying is significant. It's the reason the stock recently popped 5.5% on one day, just based on news about the buybacks.
Okay, so let's bring it all together for someone listening right now. What's the current snapshot of the stock?
As of December 6th, 2025, the stock price is sitting at $346.26. And it's had a rough year. It's down about 35% over the last 12 months.
And it's way, way off its all-time high from back in 2021.
Oh yeah, miles away from that nearly $700 peak. It is firmly in a correction.
So with that context, where does the analyst community see it going from here?
Well, despite all the bearish talk and the real risks from competition, the overall consensus from the 41 analysts we looked at is still a buy. The average 12-month price target is around $449.46.
Which from today's price is nearly 30% of potential upside.
It's a substantial potential return. But, and this is a big but,
I was going to say, I bet that average number hides a huge disagreement.
a massive one. The range of price targets just perfectly reflects the narrative tension we've been talking about. The low estimate is $270.
Wow, okay.
That reflects the deep fear that AI just commoditizes their whole business. But the high estimate goes all the way up to $605.
Believing that AI actually secures their dominance for another decade.
Exactly.
And we should get more clarity pretty soon. The next earnings report is December 10th, 2025. Q4 revenue is expected to hit about $6.11 billion. That report will be huge for seeing if that $5 billion AI revenue momentum is continuing.
It's just a fascinating case study in how a giant corporation adapts. They're making this huge bet that their deep integration and workflow lock-in will win out over the novelty of pure AI generation.
It really is. The company that basically defined creative software is now in a place where the tools are getting more powerful than ever, but the walls around its garden are starting to crumble. So, we leave you with the central dilemma of this deep dive. Is Adobe entering its strongest decade because of AI, or is competition finally catching up? Appreciate you tuning in. Until next time, stay sharp, stay patient, and let the market work for you.